You finally own your home outright. But what if that victory is quietly costing you more than you ever imagined? On a Tuesday morning in March 2019, Margaret Chen sat at her kitchen table in Portland, staring at a single piece of paper that had arrived in the mail. The letter confirmed what she'd worked toward for 23 years. Her mortgage was paid in full. She had made the final payment 6 weeks earlier, and now the house, a 3-bedroom craftsman with a small backyard, belonged entirely to her. Margaret felt a wave of relief so profound that she had to sit back down. No more monthly payments, no more interest calculations, no more envelopes from the bank. She called her daughter that afternoon to share the news, and they celebrated over the phone for nearly an hour. But 3 months later, Margaret sat in that same kitchen, running numbers on a legal pad, and the feeling was entirely different. Her financial advisor had asked her a question she hadn't anticipated. What is your house doing for you now? She had assumed the answer was obvious. It was providing shelter, security, and peace of mind. But the advisor pointed to something else. The $470,000 now locked inside the walls, doing nothing. Margaret owned an asset worth nearly $500,000, but that asset generated no income, no growth, and no liquidity. It simply sat there. If you found this video useful, please consider subscribing, liking, sharing, and leaving a comment. It helps the channel grow and allows us to continue producing documentary-style content like this. The concept her advisor described has a name in economics: opportunity cost, which represents the value of the next best alternative you give up when making a choice. In Margaret's case, the nearly $500,000 in home equity could have been deployed elsewhere, invested in stocks, bonds, real estate investment trusts, or dividend-paying assets. Historically, the S&P 500 has returned an average of about 10% annually over long periods, though with considerable year-to-year variation. If Margaret had kept a mortgage at 4% interest and invested her equity instead, the mathematical difference over a decade could amount to hundreds of thousands of dollars. But this logic rests on assumptions that don't always align with human psychology or real-world behavior. The argument for leveraging home equity emerged in the late 20th century, particularly among financial advisors serving affluent clients. These advisors observed that wealthy families rarely paid off mortgages early, instead maintaining debt while investing available capital in higher returning opportunities. The strategy became popularized through books, seminars, and financial media, eventually reaching middle-class homeowners like Margaret. By the early 2000s, cash-out refinancing had become common, allowing homeowners to extract equity and redeploy it elsewhere. Mortgage debt in the United States grew from roughly $2 trillion in 1990 to over $10 trillion by 2007. Then the financial crisis arrived, and the logic began to fracture. Millions of homeowners discovered that leverage works in both directions. It amplifies gains, but it also amplifies losses. People who had extracted equity to invest watched both their home values and their portfolios decline simultaneously. Some lost their homes entirely. What the pure mathematical argument often misses are the costs that don't appear on spreadsheets. Margaret's advisor had emphasized the 6% average return differential, but he mentioned the psychological cost only briefly. Carrying a mortgage means carrying a fixed monthly obligation, regardless of whether your income remains stable or your investments perform well. During the 2008 recession, unemployment reached 10%, and many leveraged homeowners faced a terrifying choice: make the mortgage payment or pay for groceries. Those who owned their homes outright didn't face that choice. They could reduce expenses dramatically, weather job losses, and ride out market downturns without the constant pressure of a payment deadline. There's also the question of behavior. Financial theory assumes people invest their extracted equity rationally and consistently, but research suggests this often doesn't happen. Studies from the Federal Reserve found that households frequently used home equity for consumption rather than investment, renovations, vacations, new cars, or simply higher everyday spending. The borrowed money felt different from earned income, and it disappeared faster. Meanwhile, maintaining a mortgage requires ongoing vigilance about interest rates, refinancing opportunities, and market timing. Margaret realized she didn't want that job. She was 61 years old, working part-time as a consultant, and the thought of monitoring financial markets for the next 20 years exhausted her. The paid-off house offered something the spreadsheets couldn't quantify: simplicity. Her monthly expenses had dropped by $2,000, and that reduction created a kind of freedom that no investment return could replicate. The truth, as it often does, sits somewhere between the extremes. A paid-off house isn't dead money if it's serving a purpose beyond pure financial returns. It provides housing security, reduces monthly obligations, and creates psychological breathing room that can be valuable, especially as people age or face uncertain income. For someone in their 30s with stable income and high risk tolerance, carrying a low-interest mortgage while investing aggressively might make mathematical sense. For someone in their 60s approaching retirement, the calculus changes entirely. The financial industry tends to emphasize the former scenario because it generates more activity, more transactions, and more fees. A paid-off mortgage generates no ongoing revenue for banks, no commissions for advisors, and no trading fees for brokerages. This creates a subtle but persistent bias in how the question gets framed. Margaret eventually decided to keep her house paid off, but she did make one change. She opened a home equity line of credit, not to use immediately, but as a safety net in case of emergency. The line gave her access to $100,000 at a relatively low rate, but it sat unused, costing her nothing month to month. This compromise gave her both security and flexibility without the psychological weight of mandatory payments. 2 years later, when her consulting work slowed unexpectedly, she didn't panic. She simply reduced her spending and lived comfortably on Social Security and modest savings. The house that financial theory called dead money had given her something more valuable than returns: the ability to navigate uncertainty without fear. Sometimes the most important return isn't measured in percentages, but in the quiet confidence of knowing that no matter what happens in the markets or the economy, you'll still have a place to call home.